Hi, everybody. Let's look at the operating cycle of the business and its importance in creating a classified balance sheet. Now, a classified balance sheet is one that we have taken the assets and liabilities and either made them current or non-current. Current is going to be, as it says, current a current asset is going to be converted into cash within the next period, and then the current liability is going to need that cash to be paid off within the next period. All right, what determines what's that current period? Okay, and it is the operating cycle of the business. So let's take a look at the operating cycle, and then we're going to come back and look at that criteria between current and non-current. Okay, the operating cycle of the business. You start your business with cash. The business, if it's a merchandising business, has to buy merchandise inventory so we can sell it. You got to have something to sell if you're a merchandiser, right? So it's going to take that cash, purchase and acquire inventory. Then what does the business have to do? Sell that inventory. If they don't collect the cash immediately, that becomes a receivable where people owe them the money. Then they've got to do what? Collect that receivable and turn it back into cash. This is the operating cycle of the business. Cycle for, like I say, for a merchandising business, it is cash, purchase merchandise inventory, collect, take on the receivable, collect it, get back into cash. And the typical business goes through this cycle several times a year. If you're a service business and you don't have anything to sell other than your service, your expertise, doctor, lawyer, architect, you're selling your service, you don't have to worry about the inventory, but you do have to start with cash. You do have to pay some expenses. You have to go out and sell, collect that receivable, collect it, and get your cash again. But most businesses have stuff to sell. They have merchandise inventory, so they've got to go through this cycle. And the smaller the gross profit on the product that you're selling, the more often you have to go through this cycle. If I'm selling, something relatively inexpensive and I can turn it over, I'm going through this cycle quite often. If I'm selling fancy cars or fancy watches, I'm in a high-end jewelry store, I probably won't be turning my inventory that often. So guess what? My markup, my gross profit has to be higher so I can cover my expenses. So, in a higher end, higher dollar, more specialized product, we may not be going through this cycle as often as if we've got a high volume, low margin product that we're selling, and we've got to turn it and go through this cycle a lot more often if we're going to make a profit and pay our expenses and stay in business. Okay, let's look a second then. Okay, most businesses go through the operating cycle several times a year. Think a hardware store or a clothing store. If you're a clothing store, you've got fall clothes, winter clothes, spring clothes, summer clothes. You're going through this cycle, selling your inventory several times a year. Let's say you're a long-term construction company and it takes you, you're doing large projects and it takes you 3 years to complete a project. Well, guess what? Your operating cycle is going to be 3 years because you're going from cash to inventory that you're producing, collections. This process for you is going to be about 3 years. So it makes the notation. What makes something, an asset and a liability, current or non-current? Again, the asset is current if it's going to be converted to cash within a year or this period. A liability is going to be current if it needs cash within this period. All right. Well, what's the line of demarcation between current and non-current? And let's see what it says. It's the operating cycle of the business or 1 year, whichever is longer. Guys, that's the key, whichever is longer. Most businesses go through this operating cycle several times a year. So for them, which is longer? You go through, let's say that you're the clothing store, you go through the 4 seasons. You've gone through 4 operating cycles within a year. So your line of demarcation between current and non-current is 1 year because that's longer than your operating cycle. If you're that long-term business and your operating cycle is 3 years, well, your 3-year operating cycle is longer than the 1 year. So for you, your line of demarcation is going to be 3 years. So I'm a hardware store. Let's say I've got a note payable due in 2 years. I'm a hardware store. My line of demarcation is 1 year, whether something is current or non-current. So that 2-year note payable is going to show up as a long-term liability on my books. If you're that construction company and your operating cycle is 3 years, your line of demarcation between current and non-current is 3 years. So if you've got a notes payable due in 2 years, it's going to be what? It's going to be a current liability on your balance sheet because it falls within that period of the operating cycle or 1 year, whichever is longer. So this operating cycle is very important because you have to look at it for the individual business and see how many times they're turning that merchandise inventory every year. And that's going to determine the classification of their balance sheet, where those assets and liabilities go as either classified as either current or non-current. So that is the operating cycle of the business and its importance in classifying the balance sheet. So I hope this makes sense and I hope it helps.